For what this means for the markets, let's bring in JPMorgan Asset Management's global market strategist, Meera. Pandit, welcome back. Geopolitical risk introduced in a new way, or at least a new risk for investors to consider. And I just recall, what it was 2 weeks ago, Jamie Dimon was talking about geopolitical risk as being maybe the biggest risk for markets still. How should we think about it here forward now?
When we think about the conflict that is unfolding right now overseas, of course, we cannot underscore how vast the implications are from a humanitarian perspective and from a political perspective. And of course, it's going to send some jitters through markets. But what we have seen over time is that typically the impact in the longer run from geopolitical events tends to be somewhat contained. Now, of course, that wasn't the case last year with the Russia-Ukraine conflict. So let's dissect that a little bit. Two major commodities exporters. And a big shock to energy supply and food supply at a time where the world was very vulnerable to an inflation shock. So what we're watching right now as we see this conflict unfold from an economic and market perspective is, does it widen out? Do more countries within the Middle East get involved? What is the pass-through effect potentially to things like oil? But at this point, it's day one. It's really early to say. We just advise clients to keep their cool and composure at this time as things unfold.
Most important thing for the market remains rates and the direction of interest rates. Is that fair?
I think that's fair. I mean, when we think about where the Fed is going, likely headed towards a pause in November, and from there on out, higher for longer. And we've been seeing for the last couple of weeks the effect that higher for longer is having on stocks as we realize, okay, we're not going to go back to lower rates meaningfully for a while. We're going to have to deal with this type of rate environment. I'd also fold in earnings and growth, of course, in terms of how that continues to play out into the end of this year and next year.
You think we're too optimistic on earnings projections? How do you feel about that? Because they've sort of, they've crept up and then they're pretty optimistic for 2024.
We've probably seen the worst of earnings for this year. And so what we could see is quite a nice quarter coming up in which we see revenue still holding up as the consumer holds up, margins looking a little bit better because we've seen inflation start to come down and input costs come down, wages start to come down a little bit. But as we head into next year, if we're not going to see 4% growth as we're tracking roughly right now for this quarter, and we start to see even trend growth or below, that's going to put pressure on revenues. And what could happen next year is we see a little bit of a dip then. I mean, right now expectations are for 12% growth in profits for 2024. That feels a little bit lofty, so we have to prepare ourselves from a market standpoint that might not be the outcome.
Okay, so we talked about rates. We just talked about earnings. So then let's talk about valuations, right? Because A plus B equals C. Are valuations, is the market too rich or not?
The good news about the equity market is things have come down a little bit. So if you look at the S&P as a whole, it's about 8% more expensive than long-term averages. Not great, but if you take out just the top 10 stocks, they're about 30% more expensive than long-term averages. So I do think we have to really modify our allocations in terms of where we're finding relative pricing opportunities. Look, things are better than July in terms of pricing. They're not perfect. So we have to keep that in mind. But it's just going to be a tougher environment for investing going forward, no matter whether you're looking at stocks or bonds, given the rate environment.
What area looks cheap to you in the equity market right now, especially?
Let's look outside of mega cap tech for sure. And look in certain areas within sort of the value or even more defensive areas. I mean, defensive stocks have kind of gotten crushed over the last couple of weeks.
Like staples?
Maybe more staples, maybe more healthcare, really, when we think about some of the fundamentals there potentially starting to turn around a little bit. I still think areas like energy, especially now that there's a little bit of volatility and uncertainty that energy prices could move higher. So within that, healthcare, energy, again, more value, more defensive than some of the growth names right now.
What about utilities?
Had a tough go not too long ago.
Some see opportunity in that.
I think you could start to see that turn around a little bit, but we also don't want to get overly defensive at this point in that we're not quite there where we're seeing the immediate trouble on the horizon. So it's really sort of a balance at this point.
Adam Parker started the show by suggesting we could have a pretty good chase into year end, and he definitely saw the market higher between now and then. Do you?
I'm not so sure that there's too much to chase because, again, if right now we are seeing potential for 4% growth and 12% earnings next year, I do think those expectations are going to come down throughout the rest of the quarter. Maybe people get a little bit excited about a rate pause, but then remember that we have higher for longer. So I don't know that there's going to be a huge amount of upside from here. We have to just be selective in where we're deploying money.